Morning, ladies and gents. Simon Brown here, doing a webcast this morning. Basics of investing as we move through this series we're doing every Wednesday during August and into September. Today we're looking particularly at risk management. We've looked at auto share invest. We looked at the buying of equities and ETFs within internet banking. We've looked at the tax-free. We've looked at what ETFs are. Now we want to start sort of delving a little deeper into some of the mechanics around exactly what we're looking at and how we manage the process of investing. And today, looking at risk. In the simplest sense, I suppose, what is risk? And typically we say, well, when you lose money. Well, no, that's not always the case. And to me, risk is when your investment expectation is not met. Losing money is definitely one of those, but also underperforming the market or just underperforming your expectation. If you buy a share and your expectation is that it goes up 30% in the next year, and it only goes up 20%. Well, that's a risk. Your expectation wasn't met. You didn't get the return you were looking for. Now, you haven't lost money in that scenario. You just haven't made as much. Now, the inverse is if you buy an ETF, it'll track the market. Remember, an ETF is a basket of shares, and that basket of shares is going to track the market. We have in South Africa the top 40. That is the index, the basket of the 40 largest shares in our market, and that will then match our market. So in a sense, you almost say that an ETF, as long as we're happy with that basket and what it then tracks, an ETF almost comes across as a zero risk, because sure, it will go up and down and it will fluctuate in the short term, but it will give you that market performance. Can it lose you money in the short term? Absolutely. Could it underperform your expectation? Well, again, if your expectation is that it'll go up 30% and it goes up 20%, it certainly has. But importantly, if your expectation is it'll move in sync with the market, and if the market does 30%, it'll do 30%, but if the market does -5, well, your ETF will do -5 as well. So the first point of risk is not to only look at it in that fear of losing money, but also underperforming the market. In other words, the market does better than what your portfolio is doing and not meeting your expectation. Quick last point on the second point about underperforming the market is that, these days it's easy. We use the market as a benchmark. In other words, that's how we measure our success in the investing environment. My benchmark is the top 40. If it's doing 12% and I'm doing more than 12, well, then I'm beating the market. If I'm doing less than 12, I might do 10%. But again, the expectation is to, beat the market. So 10%. So the ETF, with the right expectation, in the short term, you can lose money. In the long term, it'll generate wealth. It's going to match the market, so that risk is removed. And if your expectation is that it will match the market, well, then that risk is equally moved as well. Markets do fall. Absolutely they do. We saw it in March. Typically, day to day, week to week, even year to year, markets are trending higher. Sometimes, as we saw back in March, as we saw in 2008, as we saw post the dot-com collapse in 2001, markets go down, and they can go down aggressively in terms of price move, and fairly violently in terms of speed. And that certainly is the short-term volatility that we see in the market. Now, my rule of thumb is always quite simple. If I have cash that I expect to need in the next 3 to 5 years, whether that be for a holiday, education, maybe a deposit on a house or a new car, a wedding, I've got cash that I need in the next 3 to 5 years, I don't put it in the market, because there is a risk that over that period that I've got my deposit on the house, but in 3 years' time the market is lower, and quite simply, then I can't afford to buy the house I wanted to. I have to downgrade my expectation, or I need to wait longer for the market to recover. So, we manage the short-term market falls by taking a long-term view, by having that long-term, plus 5-year expectation in terms of what the market will do and what sort of performance it will give. Now, over 5 years, you might not get an exciting return. The top 40 over the 5 years to the beginning of this year gave you a couple of percentage points, not even annualized, just literally in total. So it really is a case of using that time on your side and diversifying. And I'm going to come to diversifying in a moment. But certainly, we manage the risk of falling markets. If you had put money in the market in January and you needed it at the end of March, well, you were only going to get 60 odd percent of your money back. Now, if you needed it today, what would be early September, you're going to get 97% of your money back, and in a couple of years, you'll probably generate a return. Now, certainly, individual stocks can go to zero or absolutely collapse in price. We have had a number over the years of bankruptcies, and that certainly is a risk. Business is a risky proposition, and some businesses simply don't survive for whatever the reason might be. Economic circumstances, fraud, changing markets, new competitors, new products, etc. So certainly in an individual stock, we can lose 100%. But the beauty of the market is that your upside is unlimited. So let's say you put a 1,000 Rand into a particular share. And that's an individual share. It's not a collective investment scheme, an ETF or a unit trust. You put 1,000 Rand into an individual share. That individual share could go bust and you could end up with zero. Or it could just collapse and your 1,000 Rand becomes 100 Rand or 10 Rand or 500 Rand. So there is downside risk in an individual share. There absolutely is. And when I talk around using longer term to reduce the risk, I'm talking about ETFs rather than individual shares. We have a number of stocks on our market at the moment during the pandemic, which are trading in some cases at the lowest levels that I've seen. My data goes back to the early 90s, and they're trading at those low levels. So if you'd invested in 1991, you have lost money, but that's an individual stock rather than a basket of shares. But whilst we've got the risk of individual stocks, we get the reward in that you could find a share that you put 1,000 Rand into, and how much could it be worth in a year or 5 or 10 or 30? Well, it could be worth, I'm going to say an infinite amount, not an infinite amount, but your 1,000 Rand could be 2,000, 10,000, 100,000. Think of some of the high flying stocks on our market. We had Kumba down at 25 Rand odd. Now it's trading above 500. Amazon, which once upon a time was a sub a $10 stock, and now trading at thousands of dollars. So you've got that asymmetrical return. Downside is capped at 100%, upside is uncapped on the individual stocks. But I much prefer a basket of shares, and that's your exchange-traded funds. We've got a video on this channel where you can find more about that. So it's exchange-traded funds. It's unit trusts at the same time. Unit trusts typically more active. And what that does is it gives you a collection of, depending on that unit trust or that exchange-traded fund, anywhere from 20 or 30 or 40 shares up to literally thousands of shares in some of the very large global diverse. And that's hugely important. Can an index go to zero? Can a basket go to zero? I mean, never say never, but a lot would have to go very, very wrong for that to happen. So that's the one way we manage that risk, is by buying those collective investment schemes, and particularly when we're starting, and particularly at the core of the portfolio. I'll talk about the core in a moment when we look at a sort of a core satellite approach. But what we're talking here is particularly as a beginner, when more likely to make a mistake, and the experts get it wrong as well very often. So start with those ETFs, start with those unit trusts, and then run a diverse portfolio. And I'm going to delve more into that, so we can park that there for now. Diversity is instant via ETFs or unit trusts. You get an ETF with 40 companies. Even if one of them does go bust, it's one of 40. It's not going to totally decimate your portfolio. But also diversify across industries, across different sectors. You don't want everything in gold mining or everything in tech. You want different asset classes. You want some shares. You want some listed property. You want cash, maybe some bonds in there as well. Now you see a lot of that in the Regulation 28 products, your retirement products, pension, provident, retirement annuities. You also want different geographies. You don't want everything put into one geographic location, one currency, South Africa and the Rand. You want to spread it around. And those ETFs do that. Even our top 40, so something in the region of 2/3 of the profit of those companies comes beyond the borders of South Africa. So you've got yourself geographic and currency exposure. Within those companies, you've got listed property and shares. You don't have any cash or bonds, but you've got the listed property and your listed share diversification. You've got different industries. You've got banks, you've got retailers, you've got food manufacturers, property stocks. So those ETFs give you nice, easy, quick diversification across all the different levels. And then, of course, regulation. Regulation is hugely important. And we actually got a couple of levels. I mean, the first set of regulation obviously is going to be the Companies Act. This is an act of Parliament, the law of the land, and that has certain requirements as to what companies and directors have to do and their fiduciary duty in that respect. But we also, if something is trading on the Johannesburg Stock Exchange, the JSE, or any other exchange, New York or Sydney, wherever it might be, that then also gives you exchange protection. I'll give you an example. A listed company has to publish results within 4 months of the period end. So if your year end, say, is December, by the end of April, your results need to be published. And if not, the JSE will suspend the company due to breach of their terms. There's certain activities, price-sensitive information, if directors are buying or selling, if someone has taken or sold a large stake within the company, this has to be notified. We've got trading updates. And that's all called SENSE. Stock Exchange News Service. And you can find that on many of the websites. You'll find it on the standard online share trading website, but many of the financial news websites will also carry SENSE. And you can go and read up about a company, see what it's doing, see are directors buying or selling, what did those results look like. Obviously, the companies themselves will have an investor relations section on their website, which will help potential investors or current investors. We've also got the FSCA. Financial Services Conduct Authority. And again, this just adds extra layers of protection to your investment. And this doesn't mean that a company can't go bust. This doesn't mean that fraud can't happen or misrepresentation of results can't happen. It absolutely can. But it does significantly limit that fact by those levels of regulation. And I have a very, very simple philosophy in my investing world is, I don't buy in my investment portfolio anything that is not exchange traded, i.e. Johannesburg Stock Exchange. But I will only buy exchange listed assets for my long-term portfolio simply because I want those extra levels of protection. That is hugely important to me, that we get that protection from the exchanges. As I said, it's not perfect, but it certainly does help. And then just a quick look through at a diverse portfolio. We typically we want to all have bought Tesla. It's the adjusted share is $2,500. It's currently at $500 because of the split. So you got 5 times as many shares as you used to have. But that was a share that literally just a couple of years ago was trading sub 50. Now it's trading around $500. That's a 10-bagger. That's gone up 1,000%. We all want the Teslas. But there's also a risk that you buy the Teslas at the top or you buy the duds. So what I like is typically at the core of my portfolio, I have collective investment schemes. Those are ETFs. In my case, you could also include unit trusts in that example. And somewhere between, frankly, 50 and 100% of your portfolio in ETFs. If you've got a tax-free account, which we spoke about in one of the earlier presentations, your tax-free account is going to be in a collective investment scheme. You can't put individual stocks in a tax-free account. And even if just at 100%, that it's nice, it's easy, it's passive. For you, it can just be a fire and forget. You go off and you buy your ETF. You can do a monthly debit via the internet banking, either Auto Share Invest or the tax-free accounts that they've got in internet banking. And you can just buy ETFs. You're going to have all those different stocks. I will shortly be owning Tesla. The reason is quite simple, is because it's going to be included in the index that I have an ETF on. I own Amazon, I own Apple, I own Microsoft, all the hot tech stocks that have been running. Well, I own a slice of all of them simply because I own exchange-traded funds. So I get those new hot stocks, and it's easy. It's a fire and forget. If you want to go into individual equity, I would cap it at 50%, and I would look at maybe even as low as 20, although quite frankly, 0 is equally a possibility here. This is individual stocks, and you'll want some 10 or 20. So what I do is I've got my cash and collective investment scheme, which sits at about 55-58% of my portfolio. And then I have a little slice of individual shares, and then I have my trading right at the top. Your cash 10 to 30%. That depend, that would include an emergency fund. It will also depend on your current, stage of life. If you're in retirement, you're probably holding a little more cash. If you're starting a career, you're probably holding a little less cash. If you're saving for a first home or a wedding or education or a birth of a baby, well, maybe there's a little more cash being held in that portfolio right now. And then your last little pointy bit, which is your trading, which is your alternatives. Alternatives would be, there's a lot of optionality in South Africa right now to invest into livestock, to invest into solar and other alternatives. Crypto would fall into that, but also would fall into your trading, your FX trading, your CFD, your crypto trading, your futures trading, whatever it might be in that case. And that really should be a very small part of your portfolio. For many, it should frankly be 0%. If you want to do it, 5 is a lot, and 10% is absolutely the most. A lot of people start this pyramid the wrong way around, where they want to start with the trading part. They've got a little bit of money. They think, I know, I'll get rich in a hurry. I'll start trading FX or crypto or something like that. And truthfully, you're a novice and you're going into a space which is highly risky, being a novice. And it is therefore a dangerous environment that you're heading into. And there's nothing wrong. Most people I know who are active in the market, who have investments, do not do any trading. In fact, truthfully, the majority that I know simply buy ETFs. Then there's a couple of the more active who are going to buy some individual shares. And then there's a very few number sort of right at the top of that pyramid who then are going to be buying the alternatives and the trading. I don't buy, question coming through, don't I have any alternatives? No, I don't have any alternatives simply because they don't trade in exchange. I do some trading on the index and the future side, some crypto, but the cows, the solar, the bees, the blueberries, and all of those, I don't have any of those at all because I don't get that level of protection that I like from having. That's it for today. Our Mondays is Market Standards, myself and Danae. Friday is looking at FunTech. We've been focusing on ETFs and the like. Wednesdays is we're running through right now the online share trading / Standard Bank investment process. And as I said, we're going to be going through, I think I've got another 3 or 4, which will take us through September as we run that as well. Ladies and gents, we'll park that there. I've hit my time. Last question coming. Yeah, so last question is, do I time my entry, Susan, from when I'm buying my ETFs? No. So today is my ETF buying day. I typically buy second work day of the new calendar month. Why the second work day of a calendar month? That was a conversation I had with myself, and at the time, my 4-year-old and 6-year-old niece and nephew, and I'm agnostic. I want to buy monthly. I could buy on the last day or the first work day or whatever it is. But Susan, no, I don't look at it and think, oh, it's expensive or oh, it's falling. I simply look at it and say, that's the ETF I buy. Thank you very much. Let me buy some more of that ETF. Ladies and gents, we will leave it there for now. Thanks very much for your time. Everyone stay safe. We will, as always, be back again next week. Cheers all.